Hello traders, welcome back to my YouTube channel. Thank you so much for clicking. Kindly remember to subscribe, like and comment down below. So I'm going to be showing you exactly how I define my daily bias. So to start off, I start from the monthly chart. So this is the monthly chart of the euro dollar. So from the monthly chart, what I want to be doing, I want to be defining the likely monthly drawn liquidity. So the drawn liquidity essentially it could be anything from an imbalance that is clearly seen. Uh, it could be an order block. So you have to have drawn liquidity in the sense that when the monthly was dropping, it hit this monthly imbalance. So once it hits that monthly imbalance, we see a reaction from the midpoint of that imbalance, and then the market is now showing willingness to drive higher. So you have to define an area in price that the market could be drawing towards when once we hit this imbalance. So that is actually essentially the monthly draw on liquidity. So for my monthly draw on liquidity, I have this imbalance right here. So you can zoom in your chart and actually you can see that there's a gap between this candle and this candle. So when this candle was created, we left a fair value gap in the middle of that gap, in the middle of the price action. So that is actually, now I've defined the monthly draw. So that's it. So that's all you need. So you just need to keep it very simple. You don't want to be overcomplicating your analysis. So from the monthly chart, now we drop down into the weekly chart. So in the weekly chart, what I like to focus on is the liquidity. So the liquidity in the direction that the monthly is drawing towards. So you see, guys, the bias is all connected. So you do not want to be defining the daily bias using the daily chart alone. You want to be defining the daily bias from the monthly and the weekly chart. So once you have the monthly drawn liquidity, you now come down to the weekly chart. So you want to spend majority of your time every week. You have to be looking at the potential direction that the weekly is pointing towards. So once you have the monthly, since the monthly takes a long time to manifest itself, the weekly chart is the most relevant, is the next relevant time frame to be looking at your direction. So in these examples, I'll be focusing on the weekly. You can see I've outlined some weekly liquidity, which is buy side liquidity. This highs right here. These are the buy side liquidity once the market was coming down from here. So essentially, what you want to be doing, how do you know that this weekly chart is drawing towards what the monthly was trying to tell us? So the first thing, once we hit this monthly imbalance, the weekly chart came up and broke above this market structure. So once this market structure is broken, you want to see the weekly now even drive further higher towards. So this already is confirmation. This is the confirmation actually we need. And even the market structure, I can define that it started from this high once this high was taken out. And I think in my video on order blocks, I outlined that these order blocks were confirmed when this high was taken out. So you can see that these weekly order blocks were relevant once this high was taken out. And that's why you see the market coming down, digging into this order block and driving higher. So actually the market moves from order block to imbalances, from order blocks to liquidity, and from imbalance to liquidity. So that's how the market flows. So actually the most important aspect of the market is liquidity and imbalances. So the market will always be drawn to those two things, liquidity and imbalance. Look at the chart, guys. Don't take my word for it. Just go back to your chart and just look at how the market moves from imbalances. It comes back to rebalance and moves away from it and then moves to the next imbalance or liquidity level. So in the weekly chart, I want to be defining the weekly levels that might be targeted once this market is drawing towards this monthly draw. So once I have defined the liquidity on the weekly, I like to drop down now to the daily chart. So that's it, guys. There's no science behind it. It's just as simple as that. So don't overcomplicate your analysis, guys. So when we drop down to the daily chart, what I like to focus on is essentially what I define as premium and discount. And when I say premium and discount, I mean when I want to be a buyer, like I'm bullish. In this instance, we are bullish on the monthly. So we have defined our Euro USD buyers as bullish. So we are bullish in the monthly and weekly. But the daily will flow from being bullish to short-term bearish to again resuming bullish. And then another short-term bearish run. So you can see like once it came off this level, we see it run higher and then comes back down, runs higher, comes back down. But this flow will always follow the weekly and the monthly is doing. So once it comes down here, we see that this was that area that actually the weekly chart hit the order block. So if you can go back to that and outline that order block so that you can see how this market is simple, guys. So once I outline that order block, this order block area, when I go back to the daily chart, you can actually see how related it is. So this is the weekly order block. So when I define this weekly order block, the daily will come back down to this area. So already when I'm in this week, for example, this is a Thursday, this is a Friday. So when I'm in on Monday, already I'm defining, since we broke structure and the market is willing, it's showing willingness that it wants to drop back down to that weekly order block. So from Monday, my daily bias will just be bearish, and then Tuesday will be bearish again, Wednesday another bearish run, and Thursday another bearish run. So once we hit that order block on the weekly, you do not want to be bearish again on the next day, which is a Friday. That's why you see this explosive move away from it. So once your target is hit, guys, kindly just exit your positions and ensure that you do not define your bias as bearish just because the market has been dropping. So once it hits that weekly objective, you want to now redefine your bias and probably anticipate a bullish run, because essentially you've already seen a breaking structure on the weekly and it might lead to another breaking structure right here. So we see that the next week they are preparing just to come and break structure again on the weekly and to draw towards that monthly. You can look at this monthly draw. So we were drawing towards this monthly. So this market is coming to this monthly objective and take out this weekly liquidity. But before it gets there, it has to come from a discount level, then rise higher into a premium, then back to a discount to a premium. So that's how you define your daily bias. So when I'm in this level here, we have hit the weekly target. From this Friday, I'm defining my bias as bullish. Until now, you see from this order block, this is what I define as a discount level. So guys, this is what I define as a discount level. So actually, this is the discount level. Now, when I'm coming down from this discount level, you want to be looking at where the premium level is. So you want to be bullish until we hit that premium level. So on the daily chart, I can define the premium level as essentially these areas. So this is the premium. So why is it a premium? It's actually a point in price where the market is in an expensive level. So this is premium. So I've defined discount, premium. So the market will always be moving from a discount to a premium. And once it gets into a premium, so this is the most premium. So the market was targeting this area before retracing again. And once we take out this premium level, the market now starts seeking a discount level. So how do you define a discount level once the market has made such a run higher and it looks like it just wants to go for this target? So actually how I define it, I use imbalances and liquidity. So in this instance, we used this, actually this was a daily imbalance. So we define this daily imbalance as a discount level. So this is another level of discount. So once you get into this discount, now you want to be defining your bias as bullish. Once we hit it, bias is bullish because the weekly is just going higher and higher and the monthly is going higher. So as long as this liquidity remains, we will be our bias will be focused on bullishness. So it does not mean that we do not trade these moves or such moves, but for instance, this is a Tuesday. Once the Tuesday took out this premium high, you want to be looking at this market probably to be seeking a discount level before it resumes higher. So always the market will come from a discount to a premium, and then from a premium to a discount, from a discount to a premium, just like that. That's the flow of the market. So in fact, I'll be watching this coming week. So This is the level actually I'm watching currently. And you'll see, guys, that this market will come back down to this level. It's actually showing signs of coming back to that level, and probably we'll be watching that. So if this market is truly still bullish, we want to see this level respond and show willingness to drive even higher towards those market monthly targets. So guys, that's how I define my daily bias. And that's it, guys. There's nothing more to it. That's all you need to define your daily bias. Thank you so much, guys, for watching. I hope this video has been helpful. If you enjoyed this video, don't forget to like, subscribe, and comment. Also, let me know what kind of content you want to see or any suggestions you have. Thank you.